Welcome back to the vlog. We are going to jump into chapter 7, continue on chapter 7, technical analysis. Okay, we ended on how to connect the dots, so that is where we will start. How to connect the dots. Successful day traders must learn to quickly and accurately identify support levels, resistance levels, and chart patterns, especially when using a discretionary trading style. While the concepts seem easy on the surface, drawing trend lines and identifying patterns is as much an art as it is a science. Novice day traders can get a feel for identifying these patterns by analyzing large numbers of charts, making price predictions, and then seeing if those predictions play out in reality. Before committing any real capital to trading, the poker analogy that we used at the beginning of the book holds true here. All poker players should be aware of concepts like pot odds, but the most successful players are those who have picked up cues over time and have learned to read other players. In the same way, day traders can understand every statistical component of the market, but the most successful ones are those who get a feel of the market's underlying psychology by reading chart patterns. Many discretionary day traders make the majority of their trading decisions based on simple support and resistance levels, combined with an analysis of a stock's order book. For these traders, an understanding of support and resistance levels as well as trend lines may be enough for them to trade successfully over time. Systematic day traders, however, rely on a greater understanding of chart patterns and technical indicators when developing trading strategies and systems, from which they would profit over time. These differing levels of understanding suggest the systematic day traders are much more interested in the science behind trading. After identifying support levels, resistance levels, and chart patterns, the next step is to connect those chart patterns with other forms of technical analysis, such as technical indicators and overlays. Chart patterns provide an indication of what will happen in the future. Technical indicators help traders time successful trades. In Figure 10, a long-term trend line provides a key support level where day traders may purchase Apple. The bounce from the support trend line combines with the bullish MACD crossover to provide a strong buy signal that sets the stage for a long-term bullish upswing. The use of multiple let's look at it. Figure 10. The use of multiple forms of technical analysis at the same time provides confirmation that a trade has a high potential for success. In general, the greater the number of signs pointing in a given direction, the greater the odds of a successful trade in that direction. The number of times that a price touches a trend line also provides confirmation of the trend line support or resistance, making it a stronger predictor of a rebound, breakout, or breakdown. Breakouts and breakdowns. Day traders like to see sharp price movements. After all, it's much more difficult to make money in the market without any price volatility. Breakouts and breakdowns occur when a price rapidly and significantly moves beyond an expected range. These patterns tend to occur when a price moves sharply outside of the normal support and resistance levels on high volume, although they may also occur at round prices or other significant levels. These breakouts or breakdowns they often signify either an acceleration or reversal of an existing trend. Breakouts occur when a price moves sharply above a key resistance level on high volume. As discussed earlier, the resistance level that becomes a support level to provide a margin of safety as the price trends higher. As discussed earlier, the resistance level then becomes a support level to provide a margin of safety as the price trends higher. Day traders often try to buy a security shortly before, during, or just after a breakout to take advantage of the change in trend. Alternatively, traders may buy the stock after it retraces back to the original breakout point, betting on the fact that the prior resistance has turned into a key support level. There are many different ways to identify potential breakouts before they happen. For example, Figure 11 shows an ascending triangle pattern in progress. Let's take a peek-see. Okay. All right, Figure 11 shows an ascending triangle pattern in progress. The key level to watch is the upper resistance at around 37.75. If the stock breaks through that level on high volume, the price could jump to the next major resistance at its prior highs of about $41. Day traders may also want to keep an eye on other technical indicators, including the MACD, RSI, and momentum indicators. Facts. To ensure that the breakout is not a false one. False breakouts happen when the price breaks through a key resistance level and, unable to keep its momentum, moves back below it. False breakouts occur when there is an insignificant momentum behind the breakout. Momentum can be measured by looking at volume. How much is being bought, and price velocity, how quickly are shares being bought. Since a false breakout represents the inability of bulls to keep momentum, it is considered a very bearish indicator and could lead to a prolonged downtrend. Breakdowns occur when a price moves sharply below a key support level and the support level becomes a new resistance level. I can't stop thinking about Ethereum. Okay. We are bouncing. Are we? We are bouncing. We are bouncing. Where are we on the stochastic? The market is fucking crazy. All right. Okay. Okay, breakdowns occur when a price moves sharply below a key support level, and the support level becomes a new resistance level. Unlike breakouts, day traders tend to sell or short sell breakdowns to profit from the rapid drop in price, either when the price breaks down below the prior support or after the support. Or after the price rebounds to the new resistance level and moves back down. Short selling involves borrowing and immediately selling an asset with an agreement to repurchase it at a later date and ideally at a lower price. The practice of short selling is less popular than buying breakouts, since the risk associated with short selling stocks are significantly greater than those of long positions. The risks that come along with short selling are less pronounced in markets like options and futures, where long and short risks are equal. As with breakouts, there are many different ways to identify breakdowns. Figure 12 shows an example of a descending triangle, followed by a breakdown below a key support level. While the move below $7.60 is a valid breakdown, this chart provides an example of a potentially false breakdown. The downward move occurred on relatively low volume, and the subsequent candle indicates a high level of indecision in the market. Two key factors that may force day traders to think twice before placing the trade. All right, the key point to remember is that breakouts or breakdowns can quickly invalidate a support or resistance level, which makes them very important to watch. When a breakout or breakdown occurs, the price tends to move rapidly as the opposite side of the market loses confidence in the prevailing trend. A new trend may develop as a result. In such a case, the only thing for which traders must watch out for is a false breakout or false breakdown, which can lead to losses. Trading gaps. Sudden price movements are potentially very lucrative for day traders. When price gaps go up, or when prices gap up or down or gap down, the market may be experiencing a knee-jerk reaction to a very positive or negative event that has occurred, due to the market being thinly traded or closed. These gaps are characterized by two bars or candles that are horizontally separated by space between their tails, so day's high or low doesn't overlap with the other day. Day traders can exploit these emotionally driven reactions to profit. The majority of gaps occur when the market opens, as overnight or pre-market news is priced into the stock. When the stocks are halted or breaking news is announced, gaps may also form as traders are forced to instantly revalue the stock, accounting for the new developments. Gaps can be risky to trade since there is typically very little liquidity during a rapid price movement, which makes it difficult to buy or sell at known prices. Those who trade gaps may not get optimal prices, particularly if they are using market orders instead of limit orders. Common gaps are area gaps that are are the most basic gaps that occur when a thinly traded stock goes ex-dividend or experiences a minor hiccup. Most of the time, day traders can ignore those types of gaps as they are filled very quickly. Filling a gap means that after the gap occurs, the price moves to cover the horizontally separated space before moving into a different direction. Day traders may be able to exploit the tendency for gaps to be filled so as to realize small profits, although opportunities are limited. Example of a common gap. So you can see when you're looking at this, there's a lot of gaps between the candlesticks, and that is a gap. Okay, all right, common gaps or area gaps. Nope, we already did that. Next. Okay, breakaway gaps. Breakaway gaps occur when a price experiences a breakout or breakdown from a trading range. When this occurs, the breakout or breakdown is instantly validated, and those on the wrong side of the trade tend to quickly head for the exits. These dynamics exacerbate the change in trend and create an opportunity for day traders to jump onto the bandwagon. Unlike common gaps, breakaway gaps usually aren't filled very quickly and instead market a potential change in the longer-term price trend. Runaway gaps. Runaway gaps occur when a price gaps higher or lower in the direction of a trend that already exists. Oftentimes, this occurs when the market suddenly realizes an opportunity and rushes to buy or sell the security all at the same time. Runaway gaps are usually followed by a prolonged move higher in the same direction as the trend, creating an opportunity for day traders to ride the market's coattails for a bit. Exhaustion gaps. Exhaustion gaps occur near the end of a trend and indicate a near-term reversal for the trend. While these can be easily mistaken for runaway gaps, the key difference is that the volume is significantly higher in exhaustion gaps due to a struggle between the bulls and the bears. Exhaustion gaps are also quickly filled as the trend reverses direction, although they may often present the best opportunities for day traders to make a profit as they are closed. Chart patterns. The financial markets are a great example of a complex system, or a system featuring a large number of interacting components which aggregate activity is nonlinear. In other words, there is no supercomputer in the world powerful enough to decipher what's going to happen next, given the millions of individual traders and investors transacting for millions of different reasons. After all, regulators can't seem to be able to prevent the most obvious market crashes. Chart patterns are designed to help day traders make sense of the chaos. Instead of trying to individually analyze millions of transactions, chart patterns visualize data from large groups of transactions. The idea is that certain patterns can be indicative of the market's aggregate mood or psychology at a given point in time. For example, an ascending triangle pattern indicates that bulls have been trying to push through a key resistance level for some time and are slowly gaining strength with each attempt, setting the stage for a potential breakout. There are literally hundreds of different chart patterns developed by technical analysts over the past several decades. In general, there are about 20 chart patterns that are widely used by day traders and should be memorized to assist in their analysis of the market. It's worth noting that these patterns appear self-explanatory, but using them in practice is more of an art than a science, since prices can be very erratic at times. Day traders should spend a lot of time studying chart patterns, using them in practice, and learning their finer points in order to become proficient in their chart analysis. Most of the time, long-term chart patterns define key support and resistance levels that day traders will watch for rebounds, breakdowns, or breakouts. Short-term chart patterns aren't quite as reliable as long-term chart patterns, but they can still provide some insights worth considering. By looking at multiple time frames, chart patterns may also overlap as to provide great insights. Okay, head and shoulders. The head and shoulders, or HNS pattern, is one of the most iconic chart patterns used to predict an overall reversal in trend. If properly identified and interpreted, the HNS pattern will provide an accurate prediction of when a trend is coming to an end, as well as a specific entry and exit points for trading the reversal. The price targets are not always reached, but H&S price targets provide a useful guideline for day traders wondering how far the reversal will run. Let's look at an example of an H&S pattern setup. In the following chart, the low at $61 even in mid-October marked the end of the first shoulder and the beginning of the head. The same price level was reached in December when the head ended and the second shoulder began. In early 2015, the neckline and the trend line was breached and the stock moved sharply lower. The day trader should watch for a rebound to the $62 level after the move and a high volume drop that confirms the pattern. When that happens, the long-term change is trend and considered likely to occur. Okay, and this is an example of a head and shoulder pattern. We have head, shoulder, shoulder, neckline. This will be best reviewed if you pull this pattern up on Google. Look at it very closely. Look at the candlesticks, which are associated with the top of the shoulder, the head. Look at the neckline. I mean, study it. But just to give you a quick example. Okay. All right, so by measuring the distance between the shoulders and the head, or in this case, $8.50, okay, the trader can determine a downside price target, which is $52.50 in this case. This price target provides a rough prediction, but other forms of technical analysis could provide better insights. For instance, a prior long-term trend line or Fibonacci retracements, more on this later, may be more accurate or ideally confirm the $52.50 level. And if that, rewind it and listen to it again, and definitely look at pictures from Google, make sure it's from a good source and it's accurate. Inverse head and shoulder patterns. Okay, as the name suggests, occurs when an inverted H&S pattern predicts a bullish change in trend. While many aspects of the inverse H&S are the same as the traditional H&S, the pattern relies more heavily on volume as a confirmation. High volume is nice to have on a traditional H&S pattern when price breaks down below support. But the inverse H&S require a high volume breakout from resistance in order to be considered valid. Okay, a few other key points include the symmetry of the pattern is important, but not necessary for it to be valid, which means that it doesn't need to be a perfect head and shoulders each time. In general, better symmetry does indicate a more reliable pattern. The more critical factor when trading an H&S pattern is properly identifying the neckline support. Once that's done, traders must ensure that the neckline key support is broken on high volume in order to confirm the breakout or breakdown. The head should be the deepest part of the H&S pattern, with the shoulders being shallower in nature, although still clearly visible in the pattern. Ideally, the shoulders are equal or roughly equal in height and width. Fire. Okay, triangles. Ascending and descending triangles are popular chart patterns for predicting breakouts, which make them particularly useful for day traders. Oftentimes, the triangles are followed by a breakout in the same direction as the prevailing trend, making them continuation patterns as opposed to reversal patterns. The idea behind triangles is that the market is either accumulating or disposing of shares up until a breaking point or key trend line where the winning side suddenly takes control of the market. Ascending triangles are bullish chart patterns that occur when a series of higher lows are made with each move higher limited to a Ascending triangles are bullish chart patterns that occur when a series of higher lows are made with each move higher limited to a horizontal resistance level. As the two trend lines converge, the day trader should watch for a breakout to occur on high volume. The price target for an ascending triangle breakout is typically the value of the height of the triangle at the beginning of the formation applied to the upper trend line's resistance. A fucking mouthful. Let's take a look at an ascending triangle pattern. In figure 17, BSX begins making a series of higher lows while hitting the same horizontal resistance on the upside. The ascending triangle pattern was followed by a high volume breakout that reached its price target of around $13.85 before retracing. Looking back to late November, the prior high presents another potential trendline resistance that occurs right around the price target predicted by the ascending triangle. Ascending triangle breakout. I'm gonna again encourage you to go check out Google, credible source, good quality pictures. Pay attention to those candlesticks. All right, where are we at? All right. Descending triangles. Descending triangles are a bearish chart pattern that occur when a series of lower highs are made with each move lower limit. What the fuck? Descending triangles are bearish chart patterns that occur when a series of lower highs are made with each move lower limited to a horizontal support level. As the two trend lines converge, day traders should watch for a breakdown to occur on high volume. The price target for an ascending triangle breakdown is usually the value of the height of the triangle at the beginning of the formation applied to the lower trend line support level. Okay, I already read that, but still, that was a lot. So, yeah. All right, let's take a look at an example. We did that, and okay, so in figure 18, CSLT makes a series of lower highs and even equal lows before experiencing a breakdown on high volume. The stock briefly saw some low volume volatility near its lower trend line before its high volume breakdown over the course of 3 days, demonstrating the importance of watching for volume as confirmation of a breakdown. In this case, the price target is equal to $4 below the lower trend line support, or roughly $7. A head and shoulder pattern can also be observed over the short term because between late November and late December, providing confirmation of a bearish downtrend to come. Okay, a few key points to remember include: the horizontal resistance or support level in ascending or descending triangles should be tested a minimum of 2 times, and ideally more than 3 times. In general, a greater number of reaction lows or high signals a greater potential breakout. Day traders often wait until just after a breakout occurs in order to buy or short in order to ensure that a valid breakout or breakdown has occurred. For example, a day trader may enter a position 1/4 point above the breakout point of an ascending triangle. Double tops and bottoms. All right, double tops and bottoms. Double tops and double bottoms are popular chart patterns that predict a reversal in long-term or intermediate-term trends. After making 2 attempts at breaking out or breaking down, the chart patterns reflect frustration by the losing side of the bull versus bear battle as they give up the fight. The price targets for these reversals are usually calculated by measuring the distance of the breakout or breakdown point to the peak or trough, and then appending that value to the breakout point in the other direction. Double tops are a bearish chart pattern that occur when there are 2 peaks followed by a high volume move lower past key support, which is defined as the low point in the trough between the 2 peaks. The price target for the chart pattern is defined as the distance from the trough support to the peak subtracted from the support breakdown. If the peaks are too close or there is insufficient volume associated with the moves, The pattern could simply be prices moving toward a key resistance level rather than a significant trend change. Let's take a look at a double top chart pattern. In figure 19, ROP experiences a double top pattern that signals an upcoming bearish reversal ahead. The stock briefly rebounds near its prior reaction lows before breaking down sharply below the trend line and confirming the pattern. In this case, the price target would be the difference between the upper and lower trend lines, or roughly $10 even, applied to the lower trend line, or roughly $140 even. So right there, those two top points that hit the line, those are your double tops. So not perfect, right? Like not like a perfect M-like shape, but that is a double top. Okay, double bottoms are bearish chart patterns that occur when there are troughs that are followed by a high volume move higher past key resistance. As with the double tops, the pattern's price target is equal to the distance between the breakout and the trough lows, and high volume moves off of the lows. High volume moves off the lows are necessary to confirm the reversal. Some other important considerations. Double tops and double bottoms can't be read in the same way across all chart types. For example, a double top on a line chart is completely different than a double top on a point in a figure chart or on other charts that discount time. Double tops and double bottoms may occur in the context of other chart patterns, such as triangles, which means it's important for traders to look at all of the angles. Double top and double bottom patterns that occur too closely together tend to be less reliable than patterns that have a greater distance apart. Rectangles are continuation patterns created by connecting two or more highs and two or more lows with parallel lines that form the top and bottom of a rectangle. Depending on the situation, rectangles may also be known as trading ranges, price channels, or congestion zones. The pattern is characterized by sideways movement, which represents a pause in the context of a larger trend where bulls and bears are consolidating their positions. The sideways trading eventually culminates in a breakout or breakdown on high volume. Let's take a look at a rectangle pattern. In figure 20, ING forms a rectangle after a significant move higher. The stock trades within the range of several months with 3 reaction highs and 2 reaction lows, indicating that the rectangle pattern is valid. After the stock breaks down from lower support on high volume, the pattern is confirmed and a downtrend is likely to ensue. The price target for that pattern is set by measuring the vertical distance of the rectangle, or roughly $2 even in this case, and applying it in the direction of the breakdown, or $11 even in this case. A few other key points to remember include: the breakdown or breakout price should be close, price should close below the pattern in order to confirm the change in direction. When the price fails to close below the upper or lower trend lines, the move may be considered a false breakout. Rectangles should not be too long or too short in duration, depending on the chart's time frame, in order to be valid. In general, day traders should watch for 2 or 3 reaction highs and lows for a valid rectangle pattern. The price often returns to the breakout or the breakdown level, which serves as a new area of support in the direction of the new trend. In some cases, the move provides day traders with a second chance to buy into the trade. And figure 20, ING rectangle pattern. Okay, flags and pennants. And before we start that, figure 21 has a pennant continuation pattern. Okay, flags and pennants. Flags and pennants are short-term continuation patterns that represent a period of consolidation before returning to the prior trend. After a strong move in either direction, the market undergoes a period of rest during which some traders take profit off the table before the trend resumes in the same direction. The price target for the pattern is calculated by measuring the distance from the base to the breakout or the breakdown of the pattern and applying the distance in the direction of the breakout or breakdown. In figure 21 that you just looked at, stock undergoes a sharp run-up in price at the beginning of January 2015. The run-up is followed by a period of consolidation that forms a pennant continuation pattern, and after the brief period of consolidation, the stock experiences a high volume breakout and then reaches the price target almost exactly. A few important considerations include: the sharp move preceding flags and pennants is highly preferred in order for the pattern to be considered valid, although not absolutely necessary. At the very least, flags and pennants with preceding price runs have higher odds of success. Makes sense. Look for volume based on confirmation before the pennant or flag, as well as during the consolidation and when the trend resumes. Oftentimes, these confirmations can help day traders avoid false positives and other concerns. Okay, coincidence or synchronicity. Many fundamental investors dismiss technical analysis as mere coincidence or synchronicity. That is, chart patterns may appear to be meaningfully coordinated but are not casually related to subsequent price changes. Ironically, these same fundamental investors believe that new fundamental developments should be reflected in prices, even though such a correlation is typically only present in the short term rather than the long term. Technical analysts believe that the price movements are a result of the market's constantly changing psychological state. For instance, the buyers that emerge at the depth of a recession aren't basing their investments on fundamental developments, since everything is still negative, but rather on the belief that prices themselves are bottoming out. Asset prices during economic crisis also tend to be dramatic, with stocks trading far below their fundamental value due to the market's perception of doom and gloom. While it is impossible to prove whether or not technical analysis works, the use of its techniques has become ubiquitous across the financial markets. Technical analysts employ these techniques to decipher the market's psychological state and ultimately arrive at decisions before the crowds. When employed properly, these predictions tend to be accurate more often than not, which suggests that there is some merit to using them. The tendency of technical predictions to materialize could be due to their predictive abilities or self-fulfilling prophecies. If all day traders are aware of technical analysis and are looking at the same charts, their similar reactions could cause price movements in the direction predicted by the technical analysis. Regardless of the underlying factors at play, there's little doubt that technical analysis serves a key purpose in the financial markets. Quick recap. Technical analysis forms the cornerstone of day trading by providing a framework for predicting future price movements through the statistical analysis of the past. While it is not a silver bullet, technical analysis can improve the odds of success when trading. Support and resistance levels are two of the most important price areas to consider when day trading. Oftentimes, these levels are used to determine when to enter or exit a position, and some day traders rely on them exclusively when trading. Support levels are prices where a stock tends to rebound higher. The greater the number of rebounds from the same level, the greater the strength of the support level, to which day traders may look to buy a stock ahead of a rebound. Resistance levels are prices where a stock tends to bounce lower. As with support levels, a greater number of rebounds lower from the price indicates greater strength for the resistance level, where day traders often look to sell or short a stock. Gaps occur when prices move higher or lower without any trading in between, which forms a visible gap on a stock chart. In general, exhaustion gaps get filled while breakaway and continuation gaps do not, presenting a potential opportunity. Technical indicators and overlays are used to analyze the statistics associated with the past price movements, which makes them ideal for identifying trend strength, gauging price movement or momentum, gauging price momentum, and determining when a trend is likely to begin or end. Chart patterns are used to identify areas where stocks will potentially break out higher or break down lower, looking at areas of support, resistance. In essence, chart patterns are indicative of underlying market psychology at play. Triangle patterns arise when a stock is making consistently higher highs or lower lows with the same support or resistance level capping the moves. Day traders should watch for a breakout from the support or resistance levels as the price band narrows. Head and shoulder patterns and reversal patterns that occur when a stock makes a reaction high or low, followed by a new high or low. Really? Head and shoulder patterns are reversal patterns that occur when a stock makes a reaction high or low, followed by a new high or low, followed by a lower reaction high or low, representing the inability of bulls or bears to maintain control over price. Double tops and bottoms represent a similar psychological state whereby bulls are unable to maintain momentum with double tops and bears are unable to maintain momentum with double bottoms. Flags and pennants are short-term continuation patterns that reflect consolidation, often near a support or resistance level before a move higher or lower. Day traders may use them as potential opportunities to buy a trend if they missed it earlier. Okay. And that concludes that chapter. All right, cool. So next chapter is number 8, how to pick a stock or crypto currency pair. Okay, cool. So next chapter is 8. We'll jump into that tomorrow. I'm gonna hold myself to that. I'm gonna hold myself to that. Thanks for joining. See you next time.